All right, good afternoon, everybody. Heading into the lunch hour here. This is Gavin McGuire, event trader, and I will be emceeing this month's trader strategy meeting. Jim is off the desk for a couple of days, just taking a little bit of a Thanksgiving break there with the family. So, with that said, I am being joined by chart trader Brett Manning, trend tracker Craig Rapisardo. We've got scalp trader Damon Southward, of course, and blue chip trader Scott Smith. How are you gentlemen doing today?
I'm okay, Gav.
Doing pretty good.
That's good.
Well, thank you.
That's good. So as we know, we're getting a little bit of selling pressure the past couple of sessions to kick off December. I know a lot of people are looking at this as perhaps a replay of last December. I think one big caveat, of course, is monetary policy is far from restrictive like it was last time around. So not sure that we should be expecting so much of a sell-off, but definitely some early pressure meeting the markets here, particularly in that cloud space. So Brett, want to start off with you as per usual, just to discuss a little bit of the lay of the land. I think we've talked about it a little bit the past couple in our last trader sentiment about how the market was a little bit priced to perfection on this trade deal, and we're starting to see some of the dangers that are with that one-sided trade there and a little bit of a risk off coming into the market. So you want to kind of recap what we're seeing out there and what you've noticed from the first 2 days of trade in December?
Yeah, sure, Gav. Putting it in context, we turned bullish, you and I, on the Sentiment and Flow show back in mid-October, looking for a breakout that was based on malpositioning among larger fund managers who had come to believe that a recession was more likely than at any time we'd seen in a number of years. And as soon as you start to see signs that we could be heading for this process of maybe exploiting that underexposure, particularly through the idea of putting together some kind of trade deal, and we possibly see a reacceleration in PMIs and in EPS over, let's say, Q4, Q1 next year, that malpositioning really is a problem for a lot of people, and they really start to scramble to try to catch back up, almost re-hedge themselves to the long side. And that was really the motivating factor, I think, for the breakout that we've seen. And the process of this trend has really been like any upward trend, particularly when you're kind of skating through to new highs. It's a process of dealing with sentiment and waiting for sentiment indicators to get to where you're seeing too much complacency or maybe too much exuberance, too much speculation in the market. And there are shorter-term versions of that type of phenomenon, and then there are longer-term versions of that type of phenomenon. We haven't seen really any of the longer-term versions, but we did, coming into this week, and I noted this yesterday morning, see one really clear red flag for the market, which is my favorite indicator for a high momentum trend in terms of starting to look for when you're going to see some kind of shakeout, and that is the ROBO ratio, which is the retail-only buy-to-open put-call ratio. Basically, it shows traders with smaller accounts, usually retail traders, and their interactions with the options market, a leveraged market, in terms of their positioning, and it's buy to open. In other words, it's establishing new exposure. So we saw that get to an extreme basically at the end of last week and into the beginning of this week, which means we've got a lot of people all in a consensus bet for shorter time frame positions, let's say weaker handed positions, levered up using a leveraged market in a crowd, opening call positions. So opening up leveraged alongside exposure to the stock market. That's where we got to start this week. So there's a big point of vulnerability, because when you get people into that situation, you're really vulnerable to a shakeout. As soon as anything goes wrong, you catch a lot of people who are maybe weak-handed market participants who are leaning the wrong way with smaller accounts that have been leveraged up. So it's really kind of it's good tinder for some kind of violent shakeout. And then the other catalyst, and we talked about this yesterday morning as well, is too much good news. I mean, so you've got Chinese manufacturing data starts to perform better than expected. I think that maybe people underestimate the importance of seeing all-time record performance for Black Friday sales, for Cyber Monday sales, as an indicator of consumer strength. The U.S. is a consumer-led economy, so when you see things like weak ISM manufacturing, it maybe suggests that there's even more of a pent-up burst to come because people are really getting behind the curve because end demand is still really strong. So you can paint all of this as a more positive than expected situation when you're looking out the next month. But because of that, because of what's happening in China with manufacturing doing a little bit better, because of what's happening in the U.S., and of course the market at all-time highs, it gives both Beijing and the White House an easy excuse to start to play hardball again. So we're seeing it just as we predicted. Both sides coming out and starting to get a little bit tougher in front of that December 15th deadline, which is still in theory on track to be a new set of tariffs, which basically is the rest of the tariffs on the Chinese economy. So that's sort of the big final, hammer for the White House to drop in this whole process. And I'm guessing, now that we're threatening that they're still going to come back on, I think that this is just in the mix of things that we've been talking about. And, of course, with so many weaker-handed market participants suddenly leveraged up long, the situation was really well set up for a sharp and violent shakeout. But it doesn't necessarily mean that that's the end of this trend, right? You're already seeing sort of the reaction put-call ratio, which I noted earlier today. But, I think that this is really – I think that I find it very hard to believe that the White House is going to let those December 15th tariffs go on. And I think the market's going to sniff that out because this is kind of their last big hammer to drop, and they're going to want to extend it out to whenever they need to get some sort of deal in place. And I think saying things like, hey, let's wait till after the election, this is just, as I said this morning, this is just Trump negotiating tactic 101. This is what he does. It's the type of thing you see in mediation with big shot lawyers going at each other across the table. It's the type of thing you see in private sector deal making, particularly in real estate. I'm going to walk away from the table. You guys are going to get nothing. That's what you say to get better terms. That's all it is, and we've seen that. But the idea that he would let these tariffs go on and then really have to start saying what he's going to ramp all the tariffs up, more and more percentage starts to get tougher. This is kind of that final step to dangle out there. And I would imagine that they'll find some excuse to be able to say, okay, I just had a great call with my good friend Xi, and he's a really terrific guy. We're great friends, and we're going to work toward a deal. They want a deal, and they're starting to come around. Something along those lines can happen December 14th. And then as a result of that, because we're getting our way, because we're winning, we're going to move the deadline back 30 days or whatever for these same tariffs. And that's a process that I think maybe the market has seen enough times to be able to start to get its arms around here. And then intraday today, I got long the market at this point. And it's really, we're seeing a situation now where we've had this flash 2-day pullback. It got to the level I talked about last week, 30.75 being a real key level for that initial pullback once you start to get this overbaked sense of the shorter term indicators in this trend. We got there, we've tested it, we've held it several times, we've held it in the midst of these headlines. We're starting to see a put-call ratio 1.3, 1.4, above 1.4. You've got real fear in a market that's still up a lot over the last month, and that's usually not the way that you get a full turn in a trend. It's part of the process, it could be, but some kind of reaction back to the upside here, as people who've just overly rehedged need to scramble back in, I think is a reasonable expectation. You never know because we can't get the microphone out of these guys' hands, so we could get more headlines later today that's going to slap this back down. But I still believe at this point to see a strong trend on daily chart time frames, 60-minute time frames, and built of the ideas that it's built of here, and coming out of that really, really deep malpositioning that we saw back in August, September, early October, a larger time frame positioning problem. We haven't really worked through all of that yet. So the first sharp pullback, headline driven, and you immediately see a sharp rise in the put-call ratio is typically, not always, nothing is always the case in markets, but typically it's something where you see a quicker than expected snapback kind of rally. And if we're starting to maybe see an ascending triangle come into place here in the S&P futures and the NASDAQ today, that could be something that triggers above maybe 3083, 3084, and you see a pretty quick trip up to 3090 if that resistance starts to give. So that's what I'm positioned for now. Obviously, it's all probabilistic. But yeah, I think that's the larger landscape and then the short-term landscape from my perspective right now where equities are concerned.
Okay. Real quick, Brett, we're going to go around to each of the traders here, and I'm curious to see what they've been seeing over the last week in given sectors. But before we jump over to the equities, just wanted to ask you your thoughts real fast on bond yields here, because I found that to be most interesting. Yesterday, they barely budged in the 10-year, just kind of floated around 182 to 185, and then all of a sudden we just saw a big dip today, meaning that it seemed like the bond market wasn't really overly concerned with yesterday's action, then all of a sudden jumped up and kind of pricked up their risk-off trading hats here. You have any thoughts on that move in yields today? And obviously, it's having a little bit of an impact on financials, which were holding up very strongly yesterday.
Yeah, well, and I would say it's more remarkable than that because yesterday, during the day it bounced around where you're saying, but that was actually a big move up in yields over last Friday.
Yeah.
So, and my understanding is that was sparked to a large extent by something that ran in the FT talking about the Fed kind of leaking a trial balloon out of letting inflation run hotter than 2% level. And, we have people positioning around that in bonds. We know that bonds were a very crowded long during the same period. So it's the inverse of the equities, essentially, with recession risk starting to be priced in, again, in this difficult late July, August, September period. And we saw bond yields go all the way back down to 1.5, 1.4 on the 10-year. And I think that to start to see the Fed willing to do that, if you've got a bunch of people still kind of crowded into bonds exposure, you're going to see that reaction. But yeah, it was remarkable to see that even mid-afternoon yesterday, they didn't start to get a clue and starting to look at it. I personally was looking at a TLT long. I did not take it, and that's certainly unfortunate given what we're seeing today.
All right, so moving on to equities, I want to get from the other traders here some of the things that they've been seeing. Scott, I know right before, about 20 minutes ago, you came on, and there was something that was jumping off the page to me, and that was healthcare and how well that's been holding up. So what are some of the things that you've been seeing in price action during the holiday week and then over these first 2 days of December, trading sessions of December, where we're seeing a little bit more selling pressure?
Yeah, so it was just kind of more of the same. I know we talked about how this market's been super strong since early October and breaking out to new fresh year-to-date highs across the board there. But what happened in late November, as of late, and I'll show it on the charts here, it was the participation of small caps and mid caps. The IWM and the MDY, they kind of stalled out there throughout the first half all the way through, let's say, first 3 weeks of November, and they just weren't keeping up with the their larger cap peers there, the SPY, the S&P, the Dow, and the NASDAQ. And that was kind of this red flag saying, like, all right, the broader market is possibly losing some momentum. We're seeing these heavyweight indices kind of leading to the upside there with gains in Apple and Microsoft. And it just kind of became a little bit more of, okay, the momentum should start to slow down a little bit because there seems to be this risk-off mentality with small caps and mid caps kind of going into a consolidation phase. Then we came right into the holiday week, which seasonality, says that majority of the, holidays and shortened work weeks tend to carry an underlying bullish bias. So Monday wasted no time. Price action just gapped up, and we just started to see all the breakouts and all the movement to the upside there going into the Thanksgiving holiday. And small caps and mid caps were no exception. Nice clean breakouts on the chart from 3-week consolidation phases. But it was kind of this last ditch effort, that we saw there in the market where we capitalized on the long side on a lot of our trades. But then come Friday's half-day session, it was like, okay, the momentum's been sucked out. We're gonna go right into the final month of the year. Come Monday, things are looking short-term, overbought in context of an 8-week rally, and it was prudent to basically not be chasing an extended upside at that point in time, and then maybe even considering, hedging of sorts, whether you were selling calls against long positions or buying puts or just flat out shorting ETFs and stocks at that point in time. I opted to choose a short in the MDY, the Midcap 400 ETF. We got short going right into Thanksgiving around 370. It was just more of me trying to get some sort of protection on my swing long balances in my portfolio there, and feel comfortable sleeping over the long weekend. Uh, so I wouldn't have to worry about any sort of aggressive selling pressure or gap against us. There wasn't particularly a gap against us yesterday, but things got pretty aggressive pretty quickly there. And I was stating, like, all right, it kind of all made sense coming off yesterday that we were selling off the way we were, but it was only day one of distribution, really. It wasn't anything, if you look at the chart of like the S&P there, it was really the first aggressive down day that we were getting. So it wasn't too surprising to see that the first of the month kind of money being taken off the table. There's a lot of year-end agendas at hand here by portfolios, whether it's to do with tax selling or just overall rebalancing and stuff. So, but then obviously we're going to be victim of geopolitical headlines that are out there, especially the ones regarding tariffs coming from President Trump. So that just kind of added to the fuel to the downside of concerns there. And I think the key thing that we have to also recognize too is that if you take a look at the VIX itself has really just been sliding for the last 8 weeks or so, getting down as low as 11, and that low volatility reading. It just suggests that there is this complacency with the market. Everyone's kind of accepted the price action going higher at that point in time, and that ties into the robo ratio that Brett was talking about. How when you get under these complacency type of scenarios, that you start to see retail-oriented, traders starting to get more aggressive at new highs, and it just tends to not work out. It tends to be more of a dumb money situation as opposed to a smart money situation that was buying up for the last 8 weeks and are just looking to start locking in some profits. So to sum things up real quick here, I mean, obviously sector rotation, I've talked about this almost every strategy meeting. It's been the lifeblood of this bull cycle that we've seen going on here for, almost a decade now. And it's pretty cyclical. Every couple quarters or 6 months, we start to see certain sectors and industries just start to achieve this new money flow. And the one big theme that we have seen over the last, since this quarter got underway in October, was this move away from utilities and REITs and staples to some degree, that were acting really strong the first 9 months of the year, and really started to lose a lot of that momentum throughout October, and started to break below key support levels and key uptrend lines, and just starting to underperform in general on a relative performance basis. And you started to see a lot more strength going into financials, technology, industrials, and healthcare. And this was all highlighted too. Again, I have control of the charts here, so I'm going to show a column here, but the recent swing trader column, I highlighted the performance of November alone as well as Q4 to date, and on the tables down here you can just see the different 11 S&P sectors and their relative performance to the S&P. You can see in November, it was exactly what I just said. REITs and utilities and staples really underperforming, discretionary to some degree along with energy. Then Q4 to date, since October began, it's pretty much that same story as well. You could throw in basic materials, but more money has been flowing back into technology, industrials, healthcare, and financials. So this is all been on our site here, and I'm a big fan of this sector rotation, relative strength, relative weakness. And when I see trends at hand, like we said, the healthcare has been pretty strong here. I like to focus on those as being the next leaders in the market, and it's been a while since we've seen healthcare really kind of take the reign here. So I think going into the end of the year as well as into 2020, we're going to have to pay a little bit more attention to some of those healthcare providers, some biotechs, some of those medical equipment names, as they've really kind of just stepped up there.
I would note, Scott, that they're certainly going to be volatile because they'll be at the center of a lot of those
talks for
presidential
elections.
debates.
Yeah.
So, yeah, so
There's no doubt about that. I mean, one of the reasons why the healthcare providers, if you look at the IHF ETF, you look at the price action over the course of the last year, been because of all the rhetoric surrounding who's running for office and what their policies are, and what they're going to try to push on everybody. So, yeah, you're definitely going to be not bored if you're involved in this space going forward. One other group that I would look at too, and it's just more of a weighting issue, is energy stocks have been underperforming for well over a year now since the correction happened back in October of last year in 2018, and they've really never made much of a strong recovery. They've been underperforming below the 200-day moving averages, and I just feel like if there's going to be, if this sector rotation is going to be coming around again, obviously there's going to be bigger geopolitical plays coming into play with crude oil and whatnot. But I feel like this is a very underinvested group at this point in time, and I think we just need to keep a lot of these names on our radar because I feel like they're going to start maybe stabilizing a little bit better here over the course of the next quarter or two, and then have some nice upside.
all right, Damon, moving on to you. I know energy's a space that you mentioned. Well, you've been mentioning it a lot recently, but I believe just a couple of sessions ago you had that as a possible December play. Curious to see what you're seeing out there over the past week. And one thing also in particular, I know you've been trading a lot around these analyst calls and the gapping up and gapping down ahead of the bell. So curious as to what trends you are seeing in that particular space.
Okay, I'll start with the last question first. I try to trade some of these cloud stocks, some of the software momentum names based on broker calls or just news that's out in the morning, just because of the volatility. We all know they have very high valuations, so typically a valuation call isn't going to necessarily change the story or change the trend in the stock. It just creates an opportunity for another short squeeze oftentimes. Going back to energy, December is typically a great month to start positioning in energy due to tax loss selling. We have a year like this when a lot of positions are down. Almost everything in energy is down in this year, this calendar year. And you're getting to the point where you're starting in the MLP space in particular, starting to see yields up into that 15% area, and very strong, fundamentally sound names with very strong partners and take or pay contracts. So I think there's going to be some compelling opportunity there. I look at the market from both a speculative standpoint as well as an investment standpoint, and the opportunity to pick up yield at 15% that I can sit on for years and years. That's very attractive to me, especially when I know that 15% yield could, in a stronger market environment, could eventually move to a 7% yield or 8% yield, which suggests pretty attractive capital appreciation in the name. So, that's where I'm focused right now. There are a couple of drillers that I'm paying attention to that are trading at very distressed levels, that have decent balance sheets, that have good hedging in place, and have the ability to, hang in there for a couple of years and, wait for natural gas prices in particular to potentially rebound. And so that's my focus. Otherwise, I'm really just being more stock specific. Looked at a situation this morning with Resi, which is one we've traded over the past month. Recent spinoff. They pushed out the CEO yesterday after several disappointing earnings reports, and which I think is a really good move. Very compelling name that I think is going to be attractive to private equity type investors as well as value investors. Stock gapped down this morning, but currently it's trading up 8%. And I think that, the market is applauding the news that they haven't found the CEO yet, but the fact that this old CEO is getting the boot, people are excited about it. So I'll stop there for now, and I'll come back to some of my individual picks later.
All right, awesome. Craig, from your perspective, I know obviously you're always steeped in following these cloud names. They've been one of the bigger selling pressures for the markets over the last couple of sessions. There's a few out this week that are on the earnings front that people will be watching: CRM, Zscaler, Coupa last night, of course. So just curious, what are you seeing out there in this space in particular? And also just on a broader earnings front, is there any trends that you're seeing developing as we're into that October end for reports and moving in towards the final month of Q3 or Q4 here? Just making sure we still got Craig on the line.
Yeah, I'm gonna hook him up real quick. Sorry about that.
Okay, sorry. All right, so just keeping an eye out. I just posted something just as a heads up until we get Craig online here. There's a Global Times tweet out that we're just watching, noting that bills on Hong Kong and Xinjiang. Yeah, I can hear you, Craig. Just give me a quick second here. And talking about radical anti-China lawmakers, obviously a shot at Rubio here. But this tweet is making its rounds, so just keeping an eye out on that. But Craig, did you hear my question to you there? Basically talking about the cloud stocks. Some of the recent earnings reports that we've seen from them, and obviously a pretty busy week of some upcoming earnings too. Just curious to what you're seeing in that space.
Yeah. So as we saw with Viva last week, and now even Coupa today, this morning after they reported last night, is just kind of a continuation of what we saw late summer and in the fall, of just kind of these valuations were kind of extended, seeing a lot of sell the news. There's nothing that I could really find in either Viva last week or Coupa last night that was really wrong with any of these reports. I think it's more just more tactical people looking to sell the news based on valuation. If a stock is trading at 20 times sales, 15 times sales, 50 times cash flow, whatever it may be, it's easy to make the case that sure, it was great, but it's all kind of priced in. So along with the broader market, we've been on a big run here. So a lot of these cloud names, got hit pretty hard in the fall or late summer, and now they've kind of rebounded, and the valuation still is sort of the primary concern, I guess you could say. The fundamental outlooks for a lot of these are very strong, but that's more or less reflected in the valuation. So we have a lot of cloud stocks out this week. ZS, CRM tonight.
What do you see as the biggest one, Craig? CRM, you figure?
They're like the bellwether, right? They're the big one, but they pretty much never really disappoint. I think it's like 14 quarters in a row that they've beaten on the top and bottom line. Part of the reason that investors are so attracted to these software as a service companies is they have their recurring revenue, so they have really high visibility. So you don't really get a lot of big surprises from somebody like Salesforce because they're so big. So it's there's more opportunity, at least in trading, in some of the smaller ones. So there's CRM. Workday. Workday is another one that's pretty scaled, that's pretty big. So Workday and Salesforce will be important tonight. But then Zscaler's one that is more of an elevated valuation. Software security is competitive, so there's been some back and forth between somebody like them and Palo Alto.
Elastic out Wednesday night. That's one that you've been following too, right? ESTC.
Yes, that is actually the one that I like the most that is reporting this week. I did add to my position, about 6 weeks ago. I think it was late October. I bought more, and it was right around this level. I think this setup into the print tomorrow afternoon is pretty pretty favorable. It isn't a cheap stock per se. I want to say it's about 13 times forward sales. And they're not really, I can see why it's underperformed as of late, because the margin profile and profitability outlook isn't really there, but that's not really why you want to own this stock. They are just in a really, really strong position. Similar to a MongoDB, they're just kind of disrupting in the data analytics space. It's a very developer-friendly technology that has a very long runway for growth. So with this stock, a good, 25% off the highs, actually below where it was last quarter, where it put up a strong quarter and rallied, but has since pulled back as just broader software sentiment has continued to sort of deteriorate. I think it's a good setup here because we should see another solid beat and raise tomorrow afternoon.
All right. So I'm going to go back around to all the traders and basically ask them what it is that they're looking out for over the month of December. Perhaps some of their favorite plays that they'll be keeping an eye out on. Certainly a lot of question marks with the trade, with the December 15th tariffs, of course. That's going to make for a little bit of volatility as we've seen to kick off the month. But Brett, we'll start off with you. What are some of the key themes you're going to be looking for in December, and any early expectations on how you think things could potentially play out? And we won't hold you to any of these guesstimates, but just looking to see what's on your radar for the next 4 weeks.
Sure. So it is, as far as I see it, still the ongoing process of this breakout and perhaps some kind of blow-off move. The degree to which that it will be impacted by the brinksmanship into the December 15th deadline is going to play a big role in determining the shape of that process. But I'm interested in a couple things outside of that. To some extent, after the OPEC Aramco IPO process concludes itself, I'm interested in shorting crude oil. And I'm also interested in seeing something like a move like postponing the tariffs and seeing that to be positive for the equities market, and seeing if my hunch is correct that gold will not shake out very hard on that, and it will present a buying opportunity in gold. So short oil, long gold, and continuing with the process of looking for some of these leading indicators to start to at least flash toward some pent-up kind of upstream supply chain management demand starting to justify some of what we've seen. I still think that's probably inevitable given kind of all of the interrelationships between variables there. And I want to see...
Does copper factor into that at all then?
So there's back to our leaning wrong portfolio idea that Gavin and I have talked about quite a bit. It seems to me that a lot of that idea has failed to really blossom. And at this point, I think that even if we start to see some of that other justification, I think we won't see it fully blossom, because I think that the market is really starting to case out the idea that there's a sort of stage play of a trade deal that's coming into place here, but it's not really impactful. And I think that that's going to be significant when it comes to longer term positioning and things like copper or the bond market. But it's, a lot of this is read and react for me. If it's really what catalysts do we get, because there's a lot of binary outcome possibilities, and then how do different assets react to the catalysts? And a lot of my larger market biases are really built of seeing how the reaction is and using that as an indication or a signal, starting to see underneath the surface of that market. If equities were to get a really positive news catalyst, the trade deal is signed or whatever, and it can't rally, that's a sign that we've got a possibility of a more significant top coming into place. It starts to get me more bearish on the equities market. That kind of process. So I can't really sit here now, given some of these binary outcome situations that we have in front of us, including OPEC. I mean, how does that really go? My sense with OPEC is that Russia is really the producers, the individual producers, are really getting fed up being put in a position where they've they're being checkmated by U.S. producers in the export market. And it's getting tougher and tougher to keep OPEC Plus together, and that's the number one thing that really is responsible for where the oil price is today. And I think that that's even playing into some of how some of these energy stocks are performing, because there's this sort of Damocles hanging over this market. And I think that we've started to see the process of managing the Aramco IPO and the process of using this OPEC meeting to, I don't think that it's coincidence that they're timed together to do that. And I think once you get past those catalysts, especially if we do see Russia kind of start to pull back from the idea, if they kind of see the writing on the wall, that they don't want to be locked into a situation where they're just losing market share to the United States by reducing their output and reducing their exports. So I think that arrangement's getting harder to keep into place. That would be another sort of deflationary pressure. But yeah, generally speaking, there's a lot of little binary catalysts that are coming at us right now, and I want to take my cues from how different asset classes react to those rather than stating a definite bias now. But I've got some if-then scenarios. For instance, if we see some bullish catalysts on oil, can't rally, that's it. We start shorting oil next week. If we see something like the December 15th tariffs postponed and a great call between Trump and Xi kind of headlines, equity markets recovering, and gold can't sell off very much, I'll probably be buying gold. So those are a couple ideas that are in the mix.
All right, fantastic. Scott, how about yourself? You talked a lot about that sector rotation. Are there any particular plays or names that you're watching over these final couple of weeks of 2019?
Nothing specifically jumps out at me just yet, but like I said earlier, and I show this on the screen here from the Swing Trader column that I recently updated, I am a big fan of relative weakness and relative strength when it comes to finding opportunities in the market. And the leading groups right now, you can see, based upon their relative performance lines and where they are positioned technically above resistance levels, it's going to be technology, industrials, healthcare, and financials. And those four sectors, obviously they got a little bit too far ahead of themselves here the last 8 weeks or so, but they look really, really good on the charts from a long-term perspective. Their relative strength is performance is there. So as we start to see some sort of pullback, a little bit of a corrective move here underway in early December, I'm really just kind of waiting for the right signs and the right names to kind of just show signs of stabilizing along key technical support levels, uptrend lines, moving averages, and just going to kind of take it from there on a swing trading basis. I'm going to look at and participate on them, hoping that there's further upside in them. Now, overall, I do have my expectations in check. Obviously, the market does look very short-term overbought, and according to the seasonality chart, December typically is a positive month on a historical basis over the last 20 years, but it's typically not as strong as the gains from October and November have been on that same bias. So I basically am looking to buy leaders on these pullbacks. But I'm not also, I'm keeping my expectations in check. I don't think we're going to be closing and finishing out the year at fresh new highs. I wouldn't be surprised if we retest any new highs, but then I think we're just going to kind of peter out momentum-wise. So it's going to be a very selective thing. And then obviously, of course, the liquid momentum focus list, which is a list that identifies the leading stocks in the market based upon their relative strength values as well as their volatility and liquidity. And this is going to be my go-to names. And obviously you're going to see that most of these industries already are part of the strong semiconductor area, some of the software names, a lot of these biotechs, medical equipment names, and those are financials are in there as well. So these, if I'm going to focus on anything specific, not only is it going to be the sector ETFs, but the specific stocks that are on the liquid momentum focus list that are really kind of setting up those nice opportunities going into year end.
All right, and Damon, you had mentioned that you got a couple of names on your list. What are some of those names and any themes that you're following? Obviously, the focus around the analyst calls, but anything else that you're going to be on the lookout as we head into the final month of the year?
So yeah, I'll go back to energy. So on the more speculative side, I'm looking at Antero Resources. Ticker is Apple Radar (AR), and this is a company that has natural gas focused entity. Has about 90% of their production hedged for the next 2 years out. Stock has just really just gotten crushed, and I think you're starting to see it stabilize a bit here, and I think it has 50 to 100% potential upside, especially if we start to see some type of rebound in nat gas. And one of the interesting things is that companies, producers are getting a lot better at they're really scaling back their capex and reducing production. They're trying to live within cash flow. It's really important. The debt markets and equity markets are pretty much closed to them. So they're being very diligent about their capital spend. And so this is a name that I think looks interesting down here as a speculative play. There are several MLPs that we're already involved in, such as DCP, which has a 15% yield at this point, which I just think is super compelling for this name. We have a full position in it, and I plan on just kind of sitting in it and riding it wherever it goes. I mean, I think it goes back up to the $25 to $27 area over time. NBLX is another name that we're involved in. It's currently trading at 2080 with a yield of about 13.5%. I'd like to see that yield get to about 14 to 14.5% before adding further to the position. So probably around the low 20s, I'd be willing to add more to the position. A lot of prefers that look interesting here. So DCP preferreds, they have a preferred B and a preferred C that are trading in the $23 area or so. Yields are about 8 and 8.5%. NS, Nancy Sarah, preferred C is trading below par. Yield of about 9.5%. I think if you get some tax loss selling into year end, you could see yields on some of these preferreds push up to the 10 to 11% range, which is why I'm not aggressively buying them now. A lot of times, especially again when you have a period of weak performance in a particular space, that end of year tax loss selling can get pretty aggressive, and you get an air pocket. And so you could see these names get swept down another 5% or so, some of the prefers, which I think would make super compelling buying opportunities. Last year, we were able to buy some of these names at 25% discount to par and see them rally all the way back to par, pick up really double-digit yields, and capture some very strong capital appreciation.
All right, fantastic. And then Craig, obviously we got some key cloud names being reported this week. What are you going to be focusing on over the last couple of weeks in December here? Any particular area or name that you got on your radar? All right, hold on. We might have lost Craig again here. Give us a quick second.
Yeah, sorry.
Hey, Gav.
There
I'm
he
back.
is. Okay.
Yeah, there's a bunch of stuff on my radar. It'll be interesting to see how these cloud software stocks react to their respective earnings reports. But as Scott was talking about biotech, obviously we've seen a decent amount of M&A kind of light a fire under some of these biotech stocks. And as everyone probably knows by now, one of my biggest positions is in Aimmune. AIMT, which should get their drug approved next month. It's one of my favorite stocks going into next year, but I also recently started positions in Guardant Health GH, which is a precision oncology company growing triple digits. Very expensive stock, in excess of 20 times sales, but the setup into the next print, which is I'd imagine early February, something like that, is bullish because they're growing like triple digits this year, and the estimate for next year is kind of a joke. It's like 30%. The stock is, it did get ahead of itself near the highs, but it's been consolidating now. I started a position in it a few weeks ago. Another one I started a position in the biotech space is Amarin, AMRN, which its fish oil derivative drug has massive potential. So this is one just to kind of keep on your radar or buy on pullbacks. It's not necessarily my style to buy breakouts, but AMRN and AIMT both sort of have that potential. They're both kind of setting up to break out. Another biotech I am long is Sage Therapeutics, ticker Sage, SAGE, and they have a really huge binary event here coming up in the next month or so for their depression drug. So luckily I have a nice little cushion in this one. I got in a little above 100. It's at 140 or 150-ish right now, and the depression data that they report over the next month is going to send it up or down 50%, something like that. So, I've tried to shy away from biotech, but it kind of just always keeps pulling me back in because there is a lot of opportunity. The risk reward is elevated for sure. So I try not to go too big. I try to keep my size smaller, but I kind of broke that rule for AIMT down at $20 just because it just was so compelling. I'm just going to keep focusing on the more company stock specific stuff heading into the new year.
All right, fantastic. Well, there you have it from our trading team. Some of the items that we'll be watching over the last month of December here, some of the things that we're seeing currently in the market. So we'll obviously continue to expand upon these thoughts and these theories and plays over the next couple of weeks. If there's any questions that anybody has on any of these, please feel free to write in. We'd be happy to answer your questions there. And we will be posting a replay of this, so feel free to give it another listen to. And if you missed anything, obviously, give it another listen to as well, and you can catch up on all these ideas. But we thank everybody for the time. We thank the traders for their time, of course, and we look forward to continuing to hear from you guys.
Thanks, Gav. See ya.
All right,
Thanks,
talk to you
guys.
soon.